It's Saturday, January 24th, 2026. The markets are closed. The ticker tape has stopped moving. But the financial system is not resting. It's vibrating. The kind of vibration you feel right before a bridge collapses. Because what just happened this week in precious metals isn't a move. It's a regime change. Silver didn't just climb. It forced its way into 3 digits and stayed there. And the deeper story isn't the headline number everyone is staring at. The deeper story is the one you can see on a chart. The pipes are clogging, the middlemen are choking, and the system is running out of credit. Look at the scoreboard and tell me this is normal. In the United States, silver closed the week around the $103 level. In China, on the Shanghai Futures Exchange, it closed near 115. Gold is parked at the doorstep of $5,000, like it's waiting for permission to kick the door in. The banks tried everything: margin hikes, engineered flushes, fear headlines, the usual psychological warfare. But $100 didn't become a ceiling, it became a floor. The message is brutal and simple. Resistance broke, the market held, and shorts just learned what it feels like when gravity changes direction. Now, zoom out. Because this weekend is not just about metals. This weekend has a war premium pulsing through the global bloodstream. We should be watching reports that the Abraham Lincoln Carrier Strike Group is moving into the CENTCOM region, one of the largest U.S. military buildups in the Middle East in modern memory. And no, you don't need to be a military analyst to understand what that means for markets. When carriers move, money moves. Capital doesn't like uncertainty, and paper assets don't survive long when the news cycle starts sounding like a drumline. War isn't just tragedy. In market terms, war is inflationary. It's deficit spending turned into a machine. It's supply chains tightening like a noose. It's oil spikes, shipping delays, and governments choosing printing over pain. And when investors can smell that kind of future, they don't seek yield. They seek survival. They move into assets with no counterparty risk. Assets you don't need permission to own, and assets that can't be defaulted on by someone else's balance sheet. Gold and silver don't care about policy speeches. They don't care about election promises. They only care about reality. This is why shorts are terrified this weekend. Ask yourself, if you're a hedge fund manager sitting in New York or London, are you really going to hold a silver short position into a weekend where the headlines could change the world overnight? Or do you flatten the book, cover risk, and live to see Monday? That fear trade is real, and it's showing up in the only place that never lies: price discovery under stress. But here's the part you won't hear on the nightly news. The move in silver isn't just demand, it's distribution failure. We uncovered the reason the supply chain is snapping. And it isn't simply because people are buying more metal, it's because the wholesalers are running out of credit. The middle layer, the boring machinery that turns refined metal into retail product, is breaking. And when that mechanism breaks, you don't get an orderly repricing, you get a super spike. The kind that happens when the system can finance the metal anymore and only cash can pull supply out of hiding. Because this weekend isn't just a geopolitical war room, it's a financial war room. The Navy is deploying in the Middle East, bullion banks are deploying in futures, and the wholesalers are bleeding out right in the middle. And once you see that, the whole silver story changes. This isn't a rally, it's a credit freeze wearing a price chart as a disguise. Before we go deeper, take 1 second and lock in here. Hit like, subscribe, and stay with us. Because what you're hearing right now is the part of the story most people will never understand until it's too late. This isn't hype. This is mechanics. And mechanics are what decide who gets metal and who gets a receipt. We obtained a letter from Dr. Tyler Wall, CEO of SD Bullion, one of the largest online precious metals dealers in the United States. They move real volume. They live inside the wholesale market every hour of every day. And when someone in that position chooses to write publicly about what's happening behind the curtain, you should pay attention like your financial future depends on it. Because it might. He describes the current state of the wholesale market with 2 words that should chill you. Absolute circus. Not colorful language, not drama, a warning. When a major industry operator calls his own market a circus, he's telling you the normal rules of trade are failing. He's telling you the machine is shaking itself apart. But the most dangerous line isn't the headline. It's the reason. He says it's becoming increasingly obvious that many large participants are either at, or very near, their maximum credit terms. And that sounds technical. It sounds boring. It is neither. It is the kind of sentence that explains empty shelves better than any demand surge ever could. Here's what that actually means. The bullion business is built on borrowed money. Wholesalers don't operate like normal retailers. They run a conveyor belt. They borrow from revolving credit lines, buy large inventory from refiners, ship it out to dealers, collect cash, repay the bank, and do it again. High volume, thin margins, constant motion. That's the system. And it works beautifully until price breaks it. Because credit lines are set in dollars, not ounces. When silver was $25 an ounce, a $10 million line could finance about 400,000 ounces. The pipe was wide. Inventory flowed, premium stayed reasonable, but at $103 silver, That same $10 million line only finances roughly 97,000 ounces. Overnight, the purchasing power of the entire wholesale layer collapses. Not because they made a bad bet, not because demand disappeared, but because the price rose faster than the banking system's willingness to expand credit. So now the wholesalers are maxed out. They hit the ceiling. They can't restock like they used to. And this is why the public is watching sold out signs spread across the market, even while prices are screaming higher. It's not just a run, it's a bottleneck. And then Dr. Wall adds another explosive ingredient. Money velocity is extremely high. Transactions are moving faster than settlement can clear. Inventory is being sold before payments fully settle. Metal is being shipped while back-end accounting is still catching up. In normal times, velocity can signal health. In a stressed logistics system, velocity becomes friction, heat, breakdown. Then comes the nail. He says the cost to maintain hedging accounts has skyrocketed, limiting how much inventory firms can carry. Wholesalers hedge by shorting futures against inventory. When price goes vertical, those shorts bleed cash. Margin calls drain liquidity. So you get the perfect storm. Credit lines buy fewer ounces, velocity clogs settlement, and hedging costs vacuum operating capital out of the system. That's why he called it a circus. Because it becomes a market where demand says buy, price says buy, but infrastructure says stop. And here's the terrifying implication. When wholesalers reach that point, you start seeing behaviors that should not exist, like no bid conditions. Not because they don't want silver, because they can't afford to take it onto their books. In a credit freeze, the system doesn't fail with fireworks. It fails with silence. No bid, no financing, no conveyor belt, just a broken chain. So ask yourself a simple question. If the middle layer can finance the metal at 103, what happens at 115? What happens at 150? The world built a silver market designed for $20, and now it has trying to survive 3 digits. That mismatch is the story. Now we enter the anomaly, the glitch in the matrix, the thing that sounds insane until you understand the plumbing. Dr. Wall says something that should not be possible in a rational market. He says many refiners and large wholesalers have a complete lack of bids on 90% silver, junk silver, constitutional coinage. And he notes secondary product is trading under spot. Let that settle in. In the middle of a historic silver run, the market is rejecting the very form of silver people trust the most. So what is 90% silver? It's pre-1965. U.S. dimes, quarters, half dollars. Real circulated money from an era when metal was money. It's fractional, recognizable, widely trusted. In a crisis, that's usually the first thing people want because it's practical, it's tradable. It's the kind of silver you can actually use without cutting a bar in half. So why would refiners and wholesalers refuse to buy it? Because in this system, speed is worth more than purity. Junk silver is 90% silver and 10% copper. That means it cannot be sold directly into industrial demand the way 999 fine bars can. A manufacturer doesn't want bags of old coinage. They want refined product. So junk has to go through a process, melting, separating copper, refining into 999, casting into bars. That takes time. 2 weeks, sometimes 4 weeks, depending on backlog. In a stable market, that timeline is normal. In a liquidity crisis, it's lethal because the wholesaler who buys that junk silver is tying up capital inside a refinery pipeline that won payout for a month. And right now, these companies are already maxed out on their credit lines. They're paying high interest. They're fighting margin calls. They need cash in 24 hours, not 24 days. So they stop bidding on junk silver, not because it's bad, not because it lost value, but because it's slow. In a credit freeze, slow inventory becomes toxic. The wholesalers want fast-moving, instantly resellable products. Eagles, maples, bars, anything that can turn into cash quickly. So junk silver gets punished with a liquidity discount. The system is choosing speed over value because the system is starving. And this is where private investors need to understand the difference between institutional reality and personal advantage. You are not a wholesaler with a ticking loan payment. You are not hedging inventory with futures. You don't need to refine coins for Samsung. If you're holding metal as a long-term hedge against currency risk, silver is silver. That means the system's refusal to buy junk silver can become your window. Because what you're watching is forced liquidation. The market is temporarily mispricing an asset because the institutions that normally keep prices efficient are locked in a credit trap. Efficient markets don't allow identical assets to trade wildly differently because of shape and processing time. Broken markets do. And broken markets reward the people who understand where the pressure is coming from. So if junk silver is being discounted while demand is exploding, that's not a sign of weakness in silver. It's a sign of weakness in credit. It's the middle layer collapsing under the weight of 3-digit pricing. And once the middle layer collapses, something else happens. price fragmentation accelerates. You start seeing one price on screens and another price on shelves. One price in New York and another in Shanghai. One price for bars and another for coins. And the more fragmented price becomes, the faster panic spreads, because panic doesn't need charts. Panic only needs scarcity. Now add the war premium back into the equation. If Middle East risk escalates and energy prices rise, refining becomes even more expensive and backlogs worsen. Smelting requires energy. Logistics require fuel. Suddenly, the time lag becomes longer, not shorter. That means the no-bid behavior could persist even as spot rises, creating even weirder dislocations. And those dislocations are how markets warn you that they are no longer normal. They are transitioning. So here, it's the real takeaway. The no bid on 90% silver is an ET proof that silver is failing. It's proof the distribution machine is failing. It's proof the financial system cannot smoothly deliver metal under stress. And if that's true, then the next phase isn't just higher prices. It's allocation, rationing, and the quiet realization that the buy button doesn't always work when credit dies. Now we reach the most counterintuitive signal of the entire weekend, and it may be the one that matters most. Dr. Wall says a lack of available financing is forcing wholesalers to dump inventory as quickly as they get it. Dump inventory. That's the language of a crash, except we're watching it happen inside a bull market. Silver is at historic highs, gold is flirting with $5,000, war risk is rising, and yet the wholesalers are selling like their lives depend on it. Because, in a way, they do. Here's the trap. When you operate on leverage, price appreciation can kill you. Not because you're wrong about direction, but because you can't survive the path. Imagine you're a wholesaler sitting on inventory financed by short-term credit. You have a bank payment due Monday. You have interest costs burning every day. You have hedges bleeding margin. You might believe silver will be higher next week, but you don't have next week. You have 48 hours. If you miss that payment, the bank cuts the line and you're finished. So you do the only thing a leveraged system can do under pressure. You liquidate. That selling creates a mirage. It can make it look like supply is appearing right when demand is rising. It can temporarily soften premiums. It can even create isolated discount deals as desperate firms prioritize speed over price. And to the untrained eye, that looks like weakness. But it's not weakness. It's distress. It's a forced transfer of metal from fragile hands to strong hands. Once the weak hands are emptied, the selling stops instantly because they can't replace what they sold. The credit freeze prevents restocking. So the liquidation phase can actually be the fuse that lights the spike. This is why we keep saying the paper price is only part of the story. The paper market reacts to headlines and positioning. The physical market reacts to financing and logistics. When both point in the same direction, you don't get gradual movement, you get repricing. And there's another layer here that you need to be aware of, especially if you're following the space online. In times like this, the chaos attracts parasites, copycats, fake accounts, channels ripping research and repackaging it as insider info. The reason that's dangerous isn't ego. It's because misinformation inside a volatile market can cost people real money. And when the market itself is unstable, trust becomes everything. So ask yourself, when the most important asset in the world becomes credibility, who are you listening to? And why? Now, let's stitch everything together. The war premium is rising, credit is freezing, wholesalers are dumping, refiners are slow, Shanghai is elevated, New York is lagging. That divergence is the kind of vacuum that pulls metal out of the West. Arbitrage doesn't care about opinions, it cares about profit. If Shanghai offers a materially higher price, metal flows east. That's why Western markets feel drained even while prices rise. The metal is being pulled through the cracks. And that leads to the question that separates casual viewers from serious thinkers. If distribution is breaking and credit is failing and war risk is rising, what exactly do you think is going to stabilize this market? A press release? A calm anchor on television? Or the sudden return of credit terms that have already been maxed out? This isn't a silver story, it's a confidence story. And confidence doesn't return because someone asks nicely. So here's the deep question I want you to answer in the comments, because it's not a chart question, it's a civilization question. If the market is already rejecting certain forms of silver because the credit system can process them fast enough, what happens when the credit system starts rejecting everything? Now we arrive at the Monday Open, the moment where pressure turns into motion. It's Saturday, January 24th. The US price is hovering around 103s. Shanghai is near 115s. Gold is circling $5,000 like a predator testing the fence. And the system is loaded with uncertainty, geopolitical risk, inflation risk, credit risk, and most importantly, credibility risk. Markets can tolerate bad news. What they can't tolerate is unresolved uncertainty. And right now, uncertainty is stacking like explosives. When the market is closed, buy orders can't execute. They just accumulate. The dam builds pressure. Then Sunday night comes, Globex opens, and the first real liquidity hits the system. If buy orders overwhelm sell orders, the price doesn't politely walk higher. It jumps, it gaps, it skips levels like they never existed. That's how you get a gap and go. This is also how the US market tries to catch up to Shanghai. That spread isn't just a number, it's gravity. It represents profit, and profit creates force. As long as the West is cheaper than the East, metal gets vacuumed toward the higher bid. That's not conspiracy, that's physics. But here's the warning. A gap up doesn't mean stability. It often means violence, because the same banks and players who failed to stop the move this week may try again. They'll use volatility as a weapon. They'll attempt quick smashes to scare new buyers into selling. They'll try to rebuild shorts at higher levels. And if you don't understand the plumbing, you'll mistake that turbulence for reversal. Yet the physical reality won't be fixed by volatility. In fact, higher prices make the credit freeze worse. If silver opens higher, the wholesalers' credit lines buy even fewer ounces. Hedging costs increase, margin pressures intensify. So you could see a higher screen price while the physical market becomes even more restricted. That's the core disconnect. Paper reacts fast. Physical breaks slow and then all at once. So what's the verdict for the week ahead? Price discovery inside a broken machine. Multiple prices, depending on form and location. One price on a futures screen, another at the local coin shop, another in Shanghai, another in the refinery pipeline where time becomes money and money becomes oxygen. And if you're trying to trade that kind of environment, you're stepping into a storm with a ruler. Broken markets don't reward precision. They reward positioning. They reward preparation. They reward understanding what is actually failing. If you find junk silver discounted because institutions are forced sellers, understand what that really is. It's not a signal that silver is unwanted. It's a signal that the credit system is choking. It is the market paying you a premium to be the liquidity provider when everyone else can breathe. Those moments don't last. When the distress inventory is cleared, the offer disappears. And when the offer disappears, the repricing happens without negotiation. And the war premium remains the wild card that can overwhelm everything. If escalation grows, safe haven demand becomes a flood. And floods don't care about forecasts. They don't care about comfort. They only care about flow. So the final takeaway is painfully simple. The system is crumbling from the inside out. First, the banks look trapped. Now the wholesalers are illiquid. Refiners are bottlenecked. Credit terms are maxed. And through all of it, the metal keeps proving something the modern world forgot. A real asset doesn't need permission to matter. If you hold physical silver, you are reducing counterparty risk in an age where counterparty risk is becoming the main risk. The public is waking up. Not because they've studied monetary history, but because fear is teaching faster than textbooks ever could. And once fear turns into understanding, buying turns into hoarding. That's when price stops behaving like a commodity and starts behaving like money again. So going into Monday, watch the spread, watch the premiums, watch the availability, watch the bids, and most importantly, watch the credit system, because credit is the invisible hand that is now strangling supply. If $100 is the floor, then the real question isn't whether silver can go higher. The question is whether the financial infrastructure can survive the path it takes to get there. Drop your thoughts below. Are we watching a temporary strain or the beginning of a permanent reset? And if the credit system can't move metal efficiently at $103, what do you think happens when the world decides $103 was cheap? Welcome to the era where sold out becomes more powerful than any headline. Hold the line, stay sharp, and I'll see you in the next briefing.